A lot of people yesterday took the comments of the Fed presidents who were interviewed as a sort of a hawkish rebellion, but there are doves out there as well. And since you got here, you've been basically telling people you're sympathetic to the rate cut cause.
Yeah, and the disagreement within the Fed, I think, is much more about how to manage the risks. And the way I see the U.S. economy is, the U.S. consumer is strong, and as long as the U.S. consumer stays strong, we're not going to have a downturn or severe downturn. We're going to have solid growth. The issue is manufacturing is weak, global growth is decelerating, and if those intensify, that's going to seep into the rest of the economy. The consumer will be the last thing to go. And what I'm concerned about is if those negatives intensify, you could have a negative jobs report in the next X number of months, and then you're going to see weakness in the consumer. And if we wait to see that, I think we've waited too long. So I'm very open-minded and constructive that we may need to make a policy adjustment here in the next X number of months. But I'm keeping an open mind, and I haven't made a decision yet, and I'll decide before the September meeting.
How big a policy adjustment in the long run do you think we need? There was Jay Powell at his July 31st press conference saying mid-course correction, and yet Wall Street pricing in right now beginning of a rate cut cycle.
Yeah, so I've been very open about saying unless I see meaningful further weakness, I view the adjustments needed as tactical. They should be limited, restrained, modest, and I don't see this as the beginning of a rate cutting cycle. But we may need to make some adjustment, and for me, the reality check on that is when I look at the Fed funds rate, I don't worry as much about the debate between ones and tens, twos and tens, and how that's moving. I look at the Fed funds rate versus the entire Treasury curve, and the whole Treasury curve has moved down in the last 3 or 4 months. The Fed funds rate is now above every rate along the Treasury curve, including the 30-year. That, for me, is a reality check that says maybe policy is tighter than I might have thought 3 or 4 months ago, and we may need to make an adjustment. And I think that's a good second check for me, which I am cognizant of.
So the December rate increase might have been a mistake?
My own view is, if you asked me on April 30th, what my forecast was for the economy, I would have said 2.5% growth, and if I was wrong, the risks were to the upside. So in April, I would have said, I had my concerns, but no, I think policy setting is about right. We then had the China issue. We then had the threat against Mexico, which might have been more significant to a number of businesses I talked to. We've had recent intensification, and now in light of these events since May 1st, now I think there's an argument, an improving argument, increasing argument that maybe the policy setting needs to be adjusted. But it's as a result of other policies away from monetary policy.
Well, why was the Mexico threat worse than the China threat?
So it's interesting. The China threat clearly affected businesses here. If you had if you sold to China, like agricultural, or if you had logistics and supply chains, that Mexico is central to so many companies in this country in terms of logistics and supply chains. When that threat occurred, even though we had a trade agreement, not ratified, but a trade agreement, that really, for the businesses I talked to, even though it didn't actually happen, it was so significant to their business that after that, most of them I talked to tell me they've now internalized that trade uncertainty is sort of a fact of life now. I think before that threat, they had thought if we can resolve some of these agreements, maybe we'll settle down. I think the Mexico threat help businesses internalize. I think trade uncertainty is going to be with us, and what I saw businesses do is become more cautious in terms of CapEx expansion plans, and I think that caution is still here today.
Well, that's not a cost of credit issue, nor is it a demand issue. So
No.
Tell me how monetary policy, you guys making a rate cut, is going to help any of this.
Yeah, so to that point, if I talk to businesses today, every one of them says to me, probably without exception, listen, availability and cost of capital is not my problem. Monetary policy, you guys are not my problem. My problem is trade uncertainty and other issues related to that are having challenging impacts on my business. Here's the issue. If you look out over the horizon, and the job of a central banker is not to look what the situation is today, is to look at what it's going to be over the next X number of months. If the policy setting is too tight, then eventually you're going to see credit tighten. You'll see that ultimately, I believe, tighten financial conditions, which will impact the economy. I think my job is to look ahead and balance these risks and to try to make risk management decisions so that the policy setting is more appropriate, because I know if it's too tight, it may seem innocuous for a number of months, but eventually I think that will lead, my own view is that will lead to a tightening of financial conditions down the road, even though we don't see it today.
But are you a hammer in search of a nail here, in the sense that people expect a Fed rate cut to solve the economy's problems,
No.
and it's not going to do that?
So quite the contrary, and you've probably heard me say, I've been very vocal in saying the fulcrum or the center of gravity in U.S. economic policy today is not monetary policy. It's trade uncertainty. It's probably immigration policy to some extent. It's policies that relate to improved skill training, infrastructure spending, but particularly in the short run, trade policy and immigration policy, policies that could help us grow the workforce. That's the center of gravity in U.S. economic policy. It's not that monetary policy doesn't have a key role to play, but it's not the fulcrum of economic policy, and I regularly call that out because I don't believe monetary policy is causing, if we have a slowdown, I don't think it's causing this slowdown. And if we have a severe slowdown, I don't think monetary policy is going to be enough to arrest it either. But it still has a key role to play. And so we've got to make good decisions about it to play that key role.
You probably know more about Wall Street than anybody else on the Fed, given your background at Goldman Sachs. Do you worry that by cutting rates, you're going to just encourage financial, shall we say, misallocations?
So you always worry, and this is one of the reasons why I've said, even though I'm open to an adjustment either in September or over the next few meetings, I'd prefer not to have to make any adjustment, because if you lower the Fed funds rate, it reduces the rate for savers. It encourages risk-taking. Now, I would also acknowledge, if you look along the whole Treasury curve, to some extent that horse has already left the barn. I mean, for investors, your fixed income alternatives have already declined substantially. The only rate that hasn't declined with it is the Fed funds rate. So I think to some extent, the incentive to increase debt or leverage, which I've called out, that's already there, because the Treasury curve is where most businesses borrow. A number of them borrow on floating rate basis, but a lot of them, to fund share repurchase or mergers, use the Treasury curve. So I'm balancing that, and I'm concerned about it. But I think most importantly, my foremost in my mind right now is, can we take steps that will help moderate this slowing we're seeing, or help with the global slowing, which might transmit to the United States, and manufacturing weakness that appears or could seep into the rest of the economy. Those are the issues I'm trying to balance.
But can't you be seen as, if you're trying to bring Fed funds down to the Treasury curve, being led around by Wall Street?
Not trying to bring it down to the Treasury curve, but I think the Treasury curve being lower is a signal that maybe monetary policy is too tight. So no, we're not going to be led around by Wall Street. I think the curve is far more driven, not by monetary policy again, but if I watch the curve extremely carefully. I've been watching markets carefully for my whole adult life. The big moves in the Treasury curve haven't been, to my eye, haven't been in response to monetary policy action or rhetoric. Have been in response to trade uncertainty and other economic policies away from monetary policy.
Last question. Do you think we can talk ourselves into recession?
Well, yes. Psychology is a critical part of the economy. And I noticed that the August consumer sentiment numbers were a little bit weaker. And I think if you have continued uncertainty, if you have intensification of trade uncertainty or trade, and not just with China, I mean more broadly, with other countries globally vis-a-vis the United States. Consumers pay attention to that, and this chain of events I mentioned earlier about weakness in manufacturing seeping to other parts of the economy, eventually affecting the jobs market. Consumers are watching that chain of events too, and are very cognizant of it in their own industry. And so sure, yeah, the psychology can turn negative and affect the economy, and we have to be cognizant of that.